Today's topic is one of the biggest curveballs we've seen in global trade in quite a while, and it has everything to do with tariffs, tech, and a strategy shift that no one saw coming. Last week, the US administration dropped a bombshell. At first glance, it looked like a full-blown escalation in the trade war. The headlines were bold, loud, and aggressive. A universal 10% tariff slapped on goods from more than 60 countries. A jaw-dropping 125% tariff specifically aimed at all Chinese imports. It sent shockwaves through global markets. Stocks tumbled. Investors panicked. And in tech boardrooms from Silicon Valley to Seoul, alarm bells were ringing. It felt like we were watching the start of a new Cold War, but this time, not with missiles and spies, but with chips and smartphones. But just when it seemed like the pressure couldn't get any higher, the US government pulled a sharp and unexpected U-turn. Late Friday night, while most people were winding down for the weekend, US Customs quietly published a document. And in that document, a long list of exemptions. Not just any exemptions, ones that carved out the heart of the tech economy. Smartphones, laptops, CPUs, memory chips, hard drives, LCD panels, even the machines used to make semiconductors. All of them suddenly, and almost quietly, removed from the tariff blast zone. It wasn't a typo. It wasn't a delay. It was a deliberate pivot. And just like that, what started as an economic earthquake turned into something else, a strategic chess move. So, what just happened? Let's take a step back. Based on last year's trade numbers, these exemptions aren't small potatoes. We're talking about over $100 billion worth of Chinese goods now shielded from tariffs, more than 22% of all US imports from China. That's huge. To give you some context, the US imported around $41 billion in smartphones from China in 2024. That's more than 80% of all smartphones sold in the US, same with laptops, over $36 billion from China alone. If this had been hit with tariffs, whether 10%, 25%, or 125%, prices would have exploded. Consumers would have been crushed. Retailers would have gone into panic mode. So this wasn't just about tweaking trade policy. It was a lifeline. Not just for companies like Apple, Dell, Lenovo, Nvidia, Intel, and Samsung, but for the entire American economy, which runs on these devices. Why? Because most of these products simply can't be made in the US anymore. There's no domestic backup plan. You can't just flip a switch and start building iPhones in Ohio. The supply chain is deeply rooted in Asia, China, Taiwan, South Korea, Japan. It took decades to build, and it's not going away overnight. Sure, we've seen moves to shift production. Apple's moving iPhone assembly to India. TSMC and Intel are building fabs in Arizona. But that's long term. Right now, in this moment, the US is still heavily dependent on imports from Asia. So when these massive tariffs were announced, and then these very specific exemptions followed, it was more than just policy, it was triage. An emergency pressure release valve to prevent the system from collapsing under its own weight. From a political lens, this marks the administration's first major de-escalation signal in this round of trade tensions. The exemptions were retroactively applied, backdated to earlier in April, right after markets nosedived on the initial news. The Nasdaq and S&P 500 both took heavy hits. China fired back with a 34% retaliatory tariff on US goods. So what you're seeing is a classic balancing act. The US wants to look tough. It wants to control trade flows, punish bad actors, and bring manufacturing back home. But it also doesn't want to break its own economy in the process. And certainly not right before an election. Let's break this down by sector. Apple, for instance, just dodged a bullet. Almost every Apple product, iPhones, iPads, Apple Watches, MacBooks, is assembled in China. A blanket tariff would have hit their margins hard. Apple would have had to either absorb the cost or pass it on to you and me. This exemption gives them breathing room. Time to keep moving assembly lines abroad. Time to renegotiate supply contracts. Time to prepare. Same goes for Nvidia. Its GPUs are designed in California but assembled overseas. CPUs, semiconductors, and the advanced lithography machines used to make them, those were all on the exemption list. That's critical. Because even if you're building chips in Arizona, you still need Dutch equipment from ASML and Japanese tools from Tokyo Electron. Those supply chains are still international, and these exemptions keep them intact. TSMC, Intel, Samsung, they're all building fabs in the US under the CHIPS Act. But we're years away from those fabs reaching scale. In the meantime, these companies need uninterrupted access to imported tools and components to stay on track. Without the exemptions, the CHIPS Act might have stalled before it even took off. But don't get too comfortable, because this could be temporary. Analysts are already warning that these exemptions come from a narrow legal maneuver. It's tied to avoiding duplicate tariffs across overlapping trade authorities. That means the government could easily reclassify these products under a different legal umbrella later, and boom, the tariffs could be back. Today's relief might be tomorrow's bargaining chip. And there's another front opening up, one that hasn't gotten as much attention, with the minimis rule. Right now, any product shipped to the US valued under $800 can bypass tariffs. That loophole has become a goldmine for fast fashion and e-commerce brands like Temu and Shein. But now, that door is closing. The administration wants to tighten the rule, especially targeting Chinese retailers. If that happens, it could fundamentally change the economics of cross-border e-commerce, and create ripple effects throughout the logistics and delivery industry. So what does all this mean for investors? First, buckle up. This is just the beginning. The trade landscape is shifting fast, and exemptions can disappear as quickly as they're announced. Expect volatility. Expect more headlines. And expect more executive orders that try to slice and dice trade policy in real time. Second, keep your eyes on the chip sector. It's no longer just about tech, it's about geopolitics. Chips are the new oil. The backbone of AI, cloud computing, defense, mobile, you name it. They are the front line in this economic Cold War. Third, remember, this isn't just a trade issue. It's a supply chain issue. A national security issue. A political issue. And at its core, a story of how countries protect their own interests in a world that's deeply interconnected. The US is walking a tightrope, and the way they target tariffs now tells us a lot about what comes next. The exemptions were surgical. They weren't broad. They were aimed right at the digital core of the economy. That's not an accident. That's strategy. But it also shows how fragile things really are. One more policy misstep, one more retaliatory move, and the whole system could be thrown into chaos again. So what do? Stay informed. Watch for signs. Follow the sectors that sit at the crossroads of politics and innovation. And most of all, don't get caught off guard. Because the trade war isn't over. It's just entering a more complex, more dangerous phase. Stick with us, and we'll help you make sense of it.